When do we know that the monetary system is dead? We will know because of silver, the gold to silver ratio. That will be the bell. Why will it be the bell? Because silver is the public's money. And when the gold derivatives finally fall and gold goes to infinity in dollar terms, the gold to silver ratio will fall to 15 to 1. And you can see here on this chart going back to 1800 why this is. There's like a wall here, a hard wall that you can't get below, and this is the 15 to 1. It happened 3 times since 1873, the crime against silver, 1919 over here after World War I, 1968, fall of the London gold pool, and finally 1980. We're going to hit this one more time. Don't know when exactly, but it's going to be quick, it's going to be sudden, and it's going to be brutal for anyone who doesn't have silver.
Rafi Farber, a financial analyst known for his contrarian economic views, focuses on the gold and silver markets. He predicts that the gold to silver ratio will fall to 15 to 1, signaling a major shift in the monetary system. Historically, this ratio was stable at 15 to 1 before 1873. However, after silver was demonetized in favor of gold, its value significantly declined, and the ratio hit a record low of 131 to 1 in March. Analysts argue that the end of the current monetary system is imminent, with the gold to silver ratio as a crucial indicator. They expect that as gold derivatives collapse and gold prices rise, silver will regain its monetary value, pushing the ratio back to 15 to 1. This shift would signify a return to silver's historical role as the people's money, driven by its renewed demand in financial transactions. Rafi Farber also emphasizes the importance of the current gold-to-oil ratio, which stands at 33.5 ounces of gold per barrel of oil. This ratio is significant because it has only been higher once in the past 50 years, excluding 2 outlier events. As of August 2024, the ratio is approximately 31 barrels per ounce, with gold priced at around $2,500 per ounce and Brent crude oil just below $80 per barrel. This current level is unusual, suggesting that oil is relatively cheap compared to gold, a discrepancy not explained by current global economic conditions. Historically, the gold-oil ratio has ranged between 6 and 40, with notable exceptions in 2016 and 2020 when it exceeded 40, reaching a peak in 2020. While the current ratio is not as extreme as during those years, it remains significant and underscores an ongoing anomaly in the oil-gold pricing relationship. Farber's observations highlight how these anomalies reflect broader shifts in economic conditions and market dynamics. Before we dive into this video, please subscribe to our channel, hit the bell icon for notifications, and share it with anyone who might find it helpful.
This is the silver to commodities ratio, and it has reached what looks like the high. I'm excluding these 2 highs here, the one from the 2011 top at 50, and this one from when commodities went way, way down in a lockdown frenzy that cured everything and solved all our problems. Yay, lockdowns. So it's here, this really is the practical top of silver to commodities. It was the top from 2011 all the way to 2013, and we reached it here in the 2016 top in gold and silver when the bull market resumed, at least in dollar terms. And then we're at it again, but I think this time we're going to break it in a sustained way, not in this way of 2011 top or the lockdown way, which gave still gold and silver an unfair advantage as other commodities went down because people were locked in their homes. But here you see that silver is slowly coming out of its monetary shell and showing that it rises over time versus other commodities, as it should and as it will continue to do. Just a reminder that the ultimate end game bell, when do we know that the monetary system is dead? We will know because of silver, the gold to silver ratio. That will be the bell. Why will it be the bell? Because silver is the public's money, and when the gold derivatives finally fall and gold goes to infinity in dollar terms, the gold to silver ratio will fall to 15 to 1. And you can see here on this chart going back to 1800 why this is. There's like a wall here, a hard wall that you can't get below, and this is the 15 to 1. It happened 3 times since 1873, the crime against silver, 1919 over here after World War I, 1968, fall of the London gold pool, and finally 1980. We're going to hit this one more time. Don't know when exactly, but it's going to be quick, it's going to be sudden, and it's going to be brutal for anyone who doesn't have silver. This shows you the gold to oil ratio since 1974. And the red line is where we are now at about 33.568. That's the close in the upper right corner over here. And so I drew a line to see, have we ever been above that ratio? And the answer is excluding this infinity thing here during the lockdowns when oil went negative. We have here, we were above it one time during the February, I think it was February 2016 oil crash from December, oh, maybe February 2015, 16, something like that. Yeah, it looks like February 2016. That was when oil crashed, I think, to about $35, and as opposed to negative $35 over here. But excluding that crash and this crash, we have never been at this ratio. It is the highest, second highest ever. If you count this as one, then this is number two. What does that mean? That means that profit margins for miners, for example, like Fortuna Mining, are near record highs. This is the baseline for miner profits, gold and silver miner profits, because what do? They buy oil and they sell gold.
Rafi Farber highlights troubling trends in the Federal Reserve's monetary policy and balance sheet. He notes that from June 2022 to early 2024, the U.S. experienced about a year and a half of absolute deflation, with the money supply contracting. Although the inflation rate briefly rose, it soon fell back down. Currently, the U.S. inflation rate stands at 2.89%, a decrease from 2.97% last month and 3.18% a year ago, and below the long-term average of 3.28%. This rate marks a significant drop from the pandemic-era peak of 9.1% in 2022, with projections indicating it will decline further to 2.1% by 2029. The inflation rate reflects the percentage increase in the price of a selected basket of goods and services purchased in the U.S. over the past year. In addition, Farber observes that the quarterly annualized money supply growth rate is just above zero and is expected to stay at this level. The absolute money supply growth continues to fall below the 2010 to 2020 trend line, and despite a recent upturn in early 2024, it remains on a declining path. Let's get back to the video.
This is the quarterly annualized money supply growth rate for dollars in the Federal Reserve banking system. So we have here, this line over here is 0%. This means absolute deflation, anything below this line. And we've seen here that we were in absolute deflation from about June 2022 until turn of the year 2024. So almost a year and a half in absolute deflation of a shrinking money supply. There was a brief spurt in the inflationary rate here of increased money supply, and then we dipped below zero right here for, I think, 2 or 3 weeks, and then we're just above it. We're going to be meandering around the zero line for a while. That means that, we're running out of steam here. And if you look at the absolute money supply, this black line, I'll explain in a second, I drew this black line and put it as the trend line for 2010 until 2020. So this line represents the slope of these little bumps over here from 2010 to 2020. And then I took that line and I moved it up to see if the current slope of money supply growth matches the 2010 to 2020 trend line, and it doesn't. We're still below that trend line, even if you count from here, even if you want to count the money supply starting to grow again from here, or just before the turn of 2024, we're still below that line and falling. So even though money supply is growing very, very slowly, and we're not back up even to this trend line from 2010 to 2020. Now, this is an interesting chart. I have to explain it. I configured it myself. So this is the weekly losses of the Federal Reserve translated into percentage of the monetary base. This is how many dollars, what percentage of the monetary base is becoming deferred assets. Deferred assets are assets that do not exist, and they are on the Fed's balance sheet because they owe it to the Treasury. And this is the percentage of dollars per week that are backed by deferred assets, things that do not exist. We say that the dollar is not backed by anything, but it is. It's backed by some amount of gold, some tiny amount of gold versus the amount of bonds. It's backed mostly by bonds. I think 92% bonds or treasuries. So those are the assets that back the dollar, except the deferred assets literally are not anything at all. So we have here 0.15288% of the monetary base per week is turning into deferred assets. If you do the math of 100 divided by 0.15288, you get a theoretical number of 12 years. In 12 years at this rate, all dollars will be backed by deferred assets. Now, obviously, there's going to be a crisis way before then. You don't need 100% of your dollars to be backed by literally nothing to enter hyperinflation. The actual amount you need is much, much lower than that. I don't know what the amount is, but it's not 100%. Right now, cumulatively, we're about 3.2% of all dollars backed by literally nothing. And this is going to rise as QT, quantitative tightening, continues, and the Fed continues to accumulate more and more losses every week.
Gold and silver are set to become essential assets as traditional monetary systems face significant upheaval. With inflation anticipated to decline and persistent anomalies in gold and silver pricing ratios, both metals are expected to strengthen as safe havens. As inflation diminishes and deflationary pressures continue, gold is likely to appreciate, reinforcing its role as a safeguard against economic uncertainty. What do you think about these trends and their potential impact on the financial markets in the coming years? We'd love to hear your thoughts, so please drop your comments below. If you found this analysis on gold, silver, and inflation trends insightful, make sure to like, comment, and subscribe for more updates. Thank you for watching, and we'll see you in the next video.